So we did see the S&P 500 fall by about 2.7% on Friday. I mean, as we've talked about in the video Thursday, as we talked about on the video last weekend, the market was sort of uh, overcoiled from a volatility standpoint. We're going to go through that again today to kind of get a sense of where we are. But right now, I just wanted to start off by saying that, the S&P fell below the 20-day moving average, which does trigger some systematic funds in terms of CTAs, right? And so those of you that don't know CTAs are sort of trend chasing, trend following, and typically when you start seeing when you start seeing the 20-day moving average rolling over, that can lead to these systematic funds triggering and becoming sellers in this market. Just like when it rolls higher, systematic funds become buyers of the market, and when it rolls over, systematic funds become sellers of the market. So my guess would be, as long as we stay below the 20-day moving average, systematic funds are likely going to be sellers in this marketplace, and that's something that we'll need to consider as well as we move forward. Additionally, we've also saw 3-month realized volatility rise off of some of those really low levels. And I think this is important because usually when you get 1-month realized volatility rise above 3-month realized volatility, that also can trigger volatility control funds to become sellers as well. So right now there's the potential here that you could have like these mechanical forces in the marketplace that could be adding to some of the selling pressure we see. But I think ultimately, though, when you talk about where we are in this equity market, we already knew coming into last week that, in fact, when you look at where 3-month realized vol was, it was around 8%. Prior to that, you had only really seen realized volatility on a 3-month basis this low in January of 2020, in October of 2018, and then in December of 2007. And in all three of those cases, you really saw these violent moves higher into the equity market, into those ultimate peaks when we got these really big pushes in realized volatility to lower levels. You saw that here in 2018, and you also saw that going into COVID. And we had the same exact kind of setup here where we saw realized volatility really come down hard. You had that big aggressive push higher, and now you're seeing perhaps the start of something a little bit bigger here on the equity market reversal. And you can also see that in 2014 we had a similar setup, but we really did a bunch of nothing really going forward after that point. So I think from a volatility standpoint, we had all the warning signs we really needed, that we were kind of overstretched, and it was really just a matter of when we were going to see some sort of sharp move down and really get that reset we need. The question, of course, is how much of a reset do we ultimately need? And that really is where it becomes harder. I mean, clearly, when you just start looking around at other parts of the market, the dispersion index, which is an important index that we've been keeping track of very closely here on the free section and in the members area, actually still continue to increase on Friday, rising to almost 39. And you can see that's a very, very high reading. And that's because you've seen, these AI technology names really outperforming, and you've had the rest of the market kind of left behind. And that creates dispersion in the marketplace. And what that basically means is that it's possible dispersion still goes even higher if we start seeing technology names, falling more than the rest of the market. So for example, on Friday, you saw the S&P 500 fall by 2.7%, and you saw the RSP equal weight fall by just 2.25%. So there's a little bit of your dispersion that you're seeing in the marketplace. The other thing that we also know is that constituent volatility is also very high. You can see this goes all the way back to about 2015 or so, I asked. And essentially, right now, you can see that constituent volatility is very high. So the average component in the S&P 500 has a very high implied volatility level. And this comes really at a time when you have somewhat subdued volatility readings on the VIX. Although we did move up to around 21, you can see that it was only around 16.5 going into Friday. And so when you look at the spread between the VIX and the equal weight, and so when you look at the spread between the VIX constituents and the VIX index, you can see that that's also historically very high. And so what that tells us is we either need to see the VIX rise more to catch up to where constituent volatility is, or we need to see the constituent volatility really begin to fall more aggressively. And in either case, that's likely going to lead to this spread really beginning to decline and collapse and return to something that's more of a normal range. And basically, once we start going through earnings season, we should begin to see the constituent volatility begin to fall regardless, because typically going into earnings, you see implied volatility on individual stocks rise, and that actually creates what's called the dispersion trade, an implied volatility dispersion trade, where market participants will go long individual stock volatility and then go short equity, S&P 500 index level volatility, and that creates an implied volatility dispersion trade. And that's part of what's been driving a lot of this equity market rally the last couple of weeks as well. And that trade, it could come under pressure pre-earnings if we continue to see volatility in the equity market really continue. And so right now, what this is all kind of pointing to is we still have the potential here for the sell-off to actually intensify from a volatility perspective, because we still, even though we saw a decent reset, there's still potentially a long way to go before we start getting, some of these metrics back to normal, when we start thinking about where volatility levels are, where dispersion is, where constituent level volatility is, and essentially what you're talking about, and realized volatility obviously being low. And then, of course, if we start factoring in systematic flows, if this were to continue on Monday, you really could be looking forward to something where we could be seeing a lot further to go to the downside. And you really can't rule out the possibility of some repeat of what we saw in this period of time, or what we saw in this period of time. I really don't want to think about this period of time, because obviously that was a very stressful and unsettling situation, similar to what we saw even in 2025 towards the end of it. I mean, certainly it's possible you could get more of a back and forth style correction in the S&P 500 like in 2022. But I'm thinking that from the market perspective, we resemble much more of this type of period of time, because if you remember, in 2018, we had the Volmageddon, and then we had that run higher really right around October of 2018, and then we ended up giving back. And if you remember, we did make new highs. And then again, in this scenario too, had a big sell-off at the beginning of the year. We ended up making new highs. And, again, there's a lot of things that rhyme in that scenario from a volatility perspective, from a market perspective. But if we kind of just think about, where our support levels are and where the market could bounce, we have to think about, some of these numbers here. And certainly 64.75 or so could certainly be one region of support. We could also be looking at some support around 62.40 or so. I mean, there are gaps actually to fill down at 6,000 and gaps to fill all the way down to 5,700. Obviously, we're getting a little bit ahead of ourselves at that point right now. But again, I still think that given where volatility metrics are, given where we are in this cycle, there's a pretty good chance that we still have a little bit more selling in front of us. I mean, the one thing that we may get on Monday, given that the VIX one day was up so high, reaching 25.7, is that there will be a little bit of a volatility reset Monday morning, meaning that this number will come down pretty sharply. Where exactly it comes in, I don't know. It could come in, sub 20, and that's going to obviously give the equity market a little bit of a boost to start Monday morning. But I think more generally speaking, as long as we stay below this 20-day moving average, right now around 66, 67, then there's probably a pretty good chance that any rally is probably going to be met with selling pressures from those systematic funds that are existing. Anyway, I hope you enjoyed this video. Please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again.